Ladies and gentlemen, thank you for your patience. Now, our next panel, as I was saying, cumulatively manages close to 42,500 crores in Indian equities. And I know that's an exciting figure, but what I need for you to understand is how to invest right and how selection plays a key role. And ladies and gentlemen, we have this next panel, which is themed where and how to aim 2.5x from equities over the next 5 years. I'm going to take the privilege of inviting and introducing our esteemed speakers. The panelists are Mr. Tridi Bhattacharya, who is the Senior Portfolio Manager at Axis Asset Management. He comes armed with over 20 years of experience in equities and portfolio management in India and other Asian emerging markets, as well as developed equity markets, ladies and gentlemen. Before joining Axis AMC, he spent a significant amount of time as a portfolio manager at State Street Global Advisors and with UBS Global Asset Management in London. A very warm welcome to you, Mr. Bhattacharya. Let me now introduce our next speaker, Mr. Prateek Agrawal, and he is the business head and CIO of ASK Investment Managers Limited. He works closely with clients and channel partners and provides strategic direction to fund managers and research teams. He holds over 27 years of experience in capital markets with a long distinguished sell-side research, investment banking and advisory experience, advisory experience also, which has been a great asset on the buy side. Now, prior to ASK Group, he was associated with SBI Capital Markets as head of research and headed equities at ABN AMRO and Bharti AXA AMCs. A very warm welcome to you, Mr. Prateek Agrawal. Let me now introduce you to Mr. Manish Sonthalia, who serves as the Executive Director and CIO Alternates and Offshore at Motilal Oswal Asset Management. He has over 22 years of experience across equity fund management and research covering Indian markets, with over 11 years with Motilal Oswal. He founded the Wide Angle Financial Services Limited in 1995, after which he served as the CEO of United Credit Securities Limited from 2000 to 2002. Before joining Motilal Oswal, he served as a vice president at SKP Securities Limited and Wealth Management Advisory Services Limited till 2004. A very warm welcome to you, sir. With that, ladies and gentlemen, I'd like to now introduce the moderator for this session, Mr. Sankalp Pal, who takes care of business development at PMS AIF World. He has more than 6 years of experience in financial planning and wealth management space. He has worked in various capacities with different wealth management companies and has comprehensive experience in cementing relationships with the clients for managing wealth as well as portfolios. Warm welcome to you, Mr. Pal. And now it's over to you to take this very, very exciting conversation forward. Mr.
Thank you so much, Aishwarya. So Prateek and Tridi, welcome back, and Manish, welcome. I think you've been on PMS AIF World for the first time. So thank you, Aishwarya, for the set of introductions. What I would like to start with is Bharat Bhai in the previous session concluded that he still feels like a kid in a candy shop, which means that India has a lot of opportunities, which kind of gives me these feelings that your job then as a fund manager or as a CIO becomes that much more difficult. Okay, you are the guys with the actual allocation decision. So with that context, let me just set how we're going to conduct this, session over the next 45 minutes. The first couple of questions is about what we will understand how 2.5x or about 20% CAGR was created in the last 5 years or 10 years, and take actual stocks, maybe, if that's okay with you, with a disclaimer that these are all educative and not necessarily advisory. And then we take up what can create. So these will be the distinct kind of, two parts to the session today. And with that, let me just give you a statistic, and then we will, go to Trideep and take learnings from you. In 2013, when India sent the last telegram, relic of the British era communication, okay, in that year, the total number of iPhones sold was around 10 million. It was around 1 million. It is 10 lakhs. In 2020, the quarter ending September, we sold 15 lakh units of iPhones. So that's a huge shift. In 7 years, we're doing more than what we did in the entire year in 1 quarter. So that's the kind of shift that happens in India, and that is how fast we adopt. Okay. So Trideep, I was just looking at your portfolio, and I will ask this question to you first before we move on to Prateek and Manish. The kind of stocks that gave 2.5x from in the last 5 years in your portfolio were Bajaj Fin and Astral. These were one of the few stocks. You can take any other example and probably tell us why you got into them, what were you thinking when you got into them, and Bajaj Finance has done much more, and why do you still hold them? So that's what we begin with, and we move with similar questions, or with the same question, to Manish and then Pratik. Over to you, Pradeep.
Yeah, thanks to, first of all, PMS AIF World, Kamal and Sankalp as a team to invite us. Be fascinating to kind of talk about and learn from. And as Bharat said, I would echo that, even today, I feel I'm in the candy shop, in the true sense, in the form of learning, as well as the opportunities that are there in front of us. And I would say that, if rather than getting into stock specific examples, if I look at whether it's Astral Poly or whether it was Bajaj Finance or whether it was Divis, I think, when we started off, when we picked these names in our portfolios, the first thing that we kind of, that we spotted was that all of these have got a honest and growth oriented management. I mean, if you look at in terms of disclosure, in terms of the way they were headed, whether you were talking about Rajiv Jain or whether you're talking about Divi or you were talking about the engineer, wherever you go, they were really honest and talking about significant amount of front of them. And I think that's one important part that we are dealing with: honest management and growth orientation with regards to. The second is basically a scalable opportunity. When we got into, let's say, an Astral and a Divis, there was a huge market share gain to be had from unorganized sector, which was due to happen, and that was lying in front of us. I'm talking about last 2 years ago. Similarly, in the case of Divis, there was a API opportunity, the China Plus One opportunity, which turned out to be a hugely scalable opportunity, not just 1 or 2 year opportunity, but a multi-decade or a meaningful opportunity to kind of come for a period of time. So the scalable opportunity is in these two cases. In the case of Astral, I would say that overall, one of the things that was there, which is my third point, is the multiple earnings drivers. So not only did they gain, from the market share gain from organized to unorganized, from unorganized to organized, they also went into multiple segments like adhesives and whatnot, which actually created upside as well. So the third point I would say is having multiple earnings drivers, not just for focusing on one particular thing, which may or may not go particularly right as a background. And finally, and probably one of the most important things is basically, a barrier to entry with regards to the product or the service. Now, whether it was the brand or whether the fact they're an industry leader or they have some an unique algorithm in the case of Bajaj Finance through which they can access the database of the customers, they had something really going for them, which they could defend in the face of competition. And the effect of that is what we see the form of a share price movement, which, as you call it, is more than 2.5x over the time period of time. So just to summarize, the 4 points that I saw through once we kind of in the examples that you gave, first and foremost was an honest and growth oriented management. Second was a very scalable opportunity, not a 1 or 2 year opportunity, but a scalable opportunity. Third is multiple earnings drivers, not just one, because a lot of things you're dealing with unknown, and a lot of things can go haywire. And finally, and most importantly, a strong barriers to entry with regards to the products or the services that they offer. So those would be, I think, 4 objective parameters which we actually saw.
Right, Tridi. Thank you, Tridi. Pratik, let's take it, from you now. Titan and PI, these I think were stellar performances amongst others. So I just cite these because I like these companies. Maybe again, caution: this is not advisory. This is just educative purpose. Tell us about your thought when you got into them, or what do you think about them now?
Yeah, sure. So over the last many years, 10, 11 years, actually, a lot of the names that have done well are common. When Tridip was saying, I was just reflecting, many of those names reflect in our portfolios as well. But yes, PI and Titan both have done very well for us. PI has been in our portfolios for a very long time, 7, 8 years. One of the best compounders for us. If I go back and really shake up memories for that time, CRAMS was something that we were focused on. And we saw that as a great long period opportunity, and we had TVs as one of the names from the space. We continued to have it for a long time, selling it briefly in between and again getting back in. TI was the other name that on the CRAM side had or held promise like DVs, in terms of return ratios, etc., and also provided a good blend of getting into newer chemistries on the ag chem side. Okay, there's once again some bit of pharma background helped. We were not really looking at large agchem companies which were mixing up, generic production, re-engineering what was there before, and then selling it in India and the West. We thought guys who do newer generation molecules only, and hence there is no conflict of interest with the technology provider, brand and sell it in the Indian marketplace will show a long runway of growth, for a long period of time. And with that mindset, got into PI. It's done spectacularly well for us. Two arms. Sometimes one does very well, sometimes the other does very well. And the good thing that is there across these names, which have multiplied and multiplied, is that the businesses are rich. They throw out free cash flow. The space is disciplined. It's not that competition comes in and says, "Yeah, you are making 100. I am happy to make 50," and cuts prices. And with the surpluses, the management is able to reinvest for gains, of a similar nature, if not better. Now, if you make money and you destroy it, you won't multiply values. You make money, the same space will grow at X. You need to grow at X plus. You need to reinvest for sustained gains, and that's the other common theme.
Right.
Titan, you are very right. Very easy. We identified the unorganized to organized space very quickly. The fact that organized branded players who will gain market share over a period of time in jewelry. We bought Titan for jewelry, nothing else. And that's continued to play out. Even as we speak, it is playing out. So those have been the thoughts.
Right. Manish, LTTS and Kotak Bank. Okay. These are the stocks that, have been wonderful for your portfolio. Okay. What were your thoughts when you got into them? Or you can use any other business from your portfolio probably to stress the point as what gets that 20% CAGR in 5 years. Over to you.
So basically, Kotak Bank we acquired through ING. We actually held ING in our portfolio, and that got acquired by Kotak. So Kotak Bank came into our portfolio. But holding on to Kotak in our portfolio was a function of understanding the risk, the ability to assess credit risk by Kotak is one of the best in the industry. Their understanding of risk is one of the best under the aegis of Mr. Kotak. I mean, it stands apart. I assume the growth on the business to be anywhere between 15 and 20%. In those days, HDFC Bank used to grow at 30%, but this bank was actually growing at between 15 to 20% only. And the markets used to reward this time capitalization, market cap increase to the extent of 30%. So, they had the best margins because the cost of capital was always on the lower side. I mean, even now, you look at it, the 60% CASA ratio is literally free money for you. You can pick and choose to whomever you want to lend, at whatever point in time you want to lend, depending on the economic cycle, and the best in class NPAs. And the journey is not ended. one may argue that valuations are on the higher side vis-a-vis other banks, so on and so forth. But the runaway to growth, if you look at HDFC Bank's advances versus what Kotak Bank's advances is, I mean, the runaway for growth is immense. And if the DNA in the system is to understand credit risk much better than most in the industry, I think markets will keep on giving you premium valuations to the rest of the bank. And that's the story which has evolved and played out magnificently well for us. LTTS, again, this is one of the instances where we bought it on the first day of the listing of the company on a limit down. The issue was very badly subscribed, or I don't even know whether it was fully subscribed. And when it listed lower circuit. And we lapped up the required quantity in a portfolio on a lower circuit. Now, the understanding was very clear. This was one of the niche plays in the engineering R&D space, right? And the size of the opportunity was big, and it was only becoming bigger. Now, understanding what they were going to do in terms of top line, bottom line growth, it was very clear that double-digit dollar terms, volume growth, will be there. The only question that I needed to understand and really reconvince myself was whether I was buying cyclical peak earnings at cyclically peak margins. So that's the call we took. And once the limit down hit and we got it at a lower price, we jumped in. And as a story evolving, with the size of the piece only growing, automation becoming the order of the day, best-in-class management, only that one needs to just see whether the execution comes through. Natural tailwind on rupee, etc., will be taken care of by the economy, etc. So it was a 20% compounding story. We bought it at lower than issue price valuations to begin with. And the story has played out. I think going forward, north of 20% type of earnings growth for this stays. And it will trade at premium valuations to the rest of the time.
Right. Thank you, gentlemen, on that answer. So what I observe as a common thread across all three of you portfolio managers is the conviction. Like Manish, in detail, you told us, a issue that would have opened 5 years ago, you bought at lower circuit. And that is the kind of detailing, or that is the kind of conviction, if the word is to be used, that I observe you have for these stocks in your portfolio. So my next question before we move on to the future bit is, what is conviction? I mean, how this conviction is derived? How do you look at something in 2016 and you say that the cash flow through 2017, 18, 19, 20 will be, maintained like this? Or how do you know that the underlying business is going to perform in a certain way? And once you probably make your assumptions, how do you keep conviction? As conviction is something which can work against us also in the market and has happened to, the best of us. So what role does conviction play? And when do you know that, that conviction that you had in a story or the earnings that had to come might, be a little bit here and there? So we start with Prateek on this, and then we take it to Manish and then Tridi. Over to you, Prateek.
Sure. So, what we do is to look at a space where there are substantial tailwinds. The probability of sustained growth is high. Be with managements who are seen to be leaders in the space, and with them, build a thesis as to this is how the business growth will play out over the next few years. And if the valuations are good, get in. Now, what we end up doing after that is to compare the delivered numbers with the thesis very regularly. Quarterly numbers happen. We compare the numbers with the thesis. If it is similar or better, we are happy to hold. If it is lower and for some reason the thesis seems to be getting impacted, then the idea is to understand for how long will it be impacted. If this is something like a demon kind of a situation, it impacts everybody. We know things will get okay after a period of time, and that period of time is also going to be similar for most. So may as well continue to repose faith in the name that one has for self. So, or if there is an impairment in a space, how long is that impairment going to be? If it is 1 quarter, 2 quarters, well, every business can see that kind of impairment. Understanding what the management is doing, how and why it will come back to track, and then watch it come back is what we do. If we believe that the impairment is going to be for a longer period of time, okay, and there are opportunities which are competing for the same position, that may actually induce us to do a trade. So yes, conviction of high order, but then also the conviction needs to be tested at all points in time.
Pratik, let me just make this a little bit interesting. Sorry, I interrupted you. Give us an actual example of what did you do with Titan when the lockdowns hit, when you knew that showrooms couldn't open for a very long time. So can you take just 2 minutes to tell us how you maintain conviction then, and then we move on to Manish on his conviction.
So once again, this was something which impacted everybody,
right?
And it's a systemic. It's not one entity impact. So, and as it moved away, it would have benefited everybody. Titan actually helped everybody by saying that they are seeing very strong moves away from unorganized. And that definitely strengthened ourselves, our resolve to continue to hold it. We actually may have improved our position there when stock had fallen that much. So depending on how much various entities had fallen in a given portfolio as a part of rebalancing. So for Titan, actually, it was relatively easy.
Right. So that's on conviction from Pratik. Manish, conviction, and how do you evaluate your conviction, and how do you take the hard call if it has to be taken?
I think conviction is a function of understanding the nitty-gritties of the business that you are investing in.
Right.
So how does that business actually make money? Which is a function of understanding the competitive advantages of particular businesses. That is the moot point, how we maintain conviction. As to how the company is going to perform into the future is also derived to some extent looking at what the company has done in the past. So the way we do it is that there has to be a threshold return on capital employed for a particular business before we start to look at that business. And for us, that number is 15%, because we think that the cost of capital of India, of doing any business in India, on a thumb rule basis, should be closer to 15%. Not talking CAPM of 11-12%, but what it takes generally to get capital to start a business. So 15% is a threshold. After that, understanding, where you stand in understanding those businesses, because everybody can't understand all the businesses. So where we live through in our circle of competence in certain businesses, and then to project the growth once the competitive advantages are met, then to project the growth, and then to evaluate the growth both on a short term and a long term, because long term is made up of many short term. So you have to evaluate these businesses on a continuous basis. So this is how, on a rough scale basis, we do it. I'll give you through an example. Of course, in all of this, the size of the opportunity matters a lot. If the profit pool is going to be a very large number going into the future, either due to the market itself growing, or it is a shift from the unorganized to the organized, or whatever, the size of the opportunity, it is big. And today we are very early in the cycle, early in that journey of growth. The younger you buy the company, or the earlier you buy the company in the cycle, the better the runaway for growth for you. I'll give you an example. We bought into Voltas very early on, when it was not only, it was a very fledgling air conditioning player, right? But the size of the opportunity in that business was very high, because just to give you some numbers, China sells some 21 crore air conditioners. Currently you are selling some 70 lakhs. And 5-10 years ago, this number was maybe hardly around 15 lakhs or 20 lakhs. So the runaway for, and mind you, India is a warmer country than China in terms of climate. What was the problem? The problem was electricity was not available. If it was available, it was very costly, and affordability was an issue, so on and so forth. So per capita income definitely plays a part when it comes to buying discretionary consumer goods, and air conditioner is obviously one of the discretionary items. Today, it might become one of the essential items: roti, kapda, makan, mobile, and maybe now in some few years from now, you will also have air conditioning. And this, GST, if it gets cut, it will get only accelerated. So air conditioning being what it is a push product, where you have to incentivize your dealers to sell your product. The shelf space of the dealer is very limited to stack only 4 or 5 brands. You can't stack the 22 brands. So the number of touch points matters in terms of what is your distribution footprint over the length or breadth of the country. And because it's a push product, the economies of scale determines how much money you make. So Voltas being the largest player with the highest market share, at around 25-26%, makes the highest margins, obviously 11 to 12%, because the economies of scale business. And the category is growing. On a thumb rule basis, roughly around 15%. So disproportionate gain for the largest manufacturer, which is Voltas. And the story has played over a period of time, and it's only playing out even now.
Right.
So, that's how we actually look at businesses. And now that they have expanded the market for themselves, getting into refrigerators, etc., dishwashers, washing machines, the runway to growth is still there. Sure. So about the business is about to go through a decline phase or saturation phase and does not reinvent itself in terms of how they look at growth. We will actually look at compounding stories where businesses can double their profits every 3 to 4 years, which is 18 to 24% compounded. Of course, short term, one-off businesses don't travel in a straight line. There could be misses in quarters. We just try to understand whether the broad story remains intact. Michael Porter's 5 forces model enables the business to earn 18 to 24% compounded for a long period of time.
Manish, that's very interesting. That's a very important point. Tridi, to you now on conviction, before we move on to the real questions about what happens in the next 5 years, let's have a bit from you on conviction.
Sure. I think picking stocks is about really 3 things. First of all, is to understand the earnings power of the business. And this earnings power of the business has got near-term events, whatever they might be. But from a medium-term perspective, is a function of where the company stacks up within the sector and how the sector stacks up within the economy in terms of growth. And I think a sum total of all of this is basically the earnings power of the business that we are evaluating. In the case of Astral, when we bought in, we realized that the earnings power of the business was actually being underestimated by the market versus what we thought it would be in 2 years' time. If we bake in the market share gain from unorganized segment, if we bake in the different segments that they could get into, and if we bake in overall, the shift that they were making on the IP side, moving on from Lubrizol. So that helped us build the conviction with regards to Astral. The second important point with regards to picking stocks is basically understanding the nature and the reason behind the mispricing. You see, at the end of the day, when we are buying a stock, we are expressing a view which is against the market and saying that we are right, but the market is wrong. And I think spending some time understanding why we think we are right versus the consensus view is something to kind of, something to ponder about. So when we got into Divi's, they had this, the visit from from FTA, and they shut down one of the units and stuff like that, and the stock corrected massively. And I think at that point in time, when we looked at Divi's history with regards to what they had done, we realized that this is a transient phase and things could actually go ahead, whereas the market was getting a bit too emotional about the short term. So, and hence we took a meaningful stake, and since then the stock has got wonderful. So understanding the nature of the mispricing is the second important thing that I would probably point out in terms of, what helps and build conviction. Right. And the third, from an evaluation standpoint, I would say that, having an objective thesis statement with regards to why we bought it and continuously evaluating this on a period of time with regards to whether things are playing out as we thought initially or better. is, I think, a good factual reality check as we kind of go on to the journey of holding on to the stock. I think if these three things, which is basically understanding earnings power of the business, understanding the nature of the mispricing, and third, basically the thesis statement and continuous evaluation of that are there, I think the conviction and other things really play out come out of all of this.
Right. Thank you so much. So now with that, now whatever we talk is going to be forward looking. So, the reason I spend some more time on what has worked and, what is conviction and how conviction works is because if you have to be a great batsman, you have to, watch Sachin Tendulkar and Gavaskar bat. Then only you can become one. So now, the question or the elephant in the room, we won't restrict ourselves to value or growth, mid cap or small cap or large cap. We just want to understand from you guys, where do you see that 20% kind of compounding? What are the sectors? What are the kind of businesses? Which sectors will see headwinds? Which sectors might see tailwinds? So the discussion is open. Be candid. And like again, the note that we started. This is a candy shop, and we are all kids here. Let's be as candid as we can. Manish, we begin with you, then Pratik, and then Tridi. Over to you.
See, we are starting FY22 on a low base. Where corporate profits to GDP is one of the lowest. We have seen a recession last year. So, at least for the next 2 years, earnings growth visibility is not of 20%. So, we really have a chance to see the, portfolios actually move up 20% CAGR over the next 2 years. Thereafter, we will see taper tantrum, obviously in 23, sometime in 23, 24. Even though earnings growth will be there, I think valuation correction is very likely post that. So on a steady state basis, if you look at next 5 years, whether 20% CAGR is possible, it is very much possible. Large parts of the unlisted segments of the economy will come into the listed segment, and we're talking about new age internet businesses and many more, disruptive businesses which can, have an accelerated growth in, who knows? I mean, electric vehicle environment and so on and so forth. There are a whole lot of disruptions happening. So I think 20% CAGR is possible. It is going to be more front-ended for the next 2 years, coming at an accelerated pace and maybe slightly muted in the latter half, but it's possible. I think headwinded will be sectors or companies where businesses are getting disrupted. Of course, it's difficult to, it's an ongoing process because even though earnings may take some while to get vitiated for these companies or sectors, P multiples are actually going to delay. That's going to happen much ahead in the cycle. So, except for that, I think broadly, IT, pharma, consumption, and also industrials, for ever since GFC, global financial crisis, we really haven't seen too much of capex. So it's at very depressed valuations, this entire piece. And there might be a rotation trade this time around, because consumer sector has done well with or without earnings. If they were, in the past, if there were no earnings, there were multiple expansion. If there was earnings, there was again a multiple expansion. So this time around, I think because of elevated valuations, there could be some normalization, and because of beaten down valuations for the entire investment related themes space, they could do much better going into the next cycle of capex formation. And that is to say the next 5 years.
Capex is one of your, areas that you feel could see some action. Good. Trideep, you have a portfolio of brands essentially, and in multiple discussions we have gotten from you, your portfolio seems like a portfolio of leaders, people who have established, some name for them in their respective business, small or large. So what's your view? What do you think you're going to be looking at in the next 5 years?
I think overall the next 5 years, 2 or 3 things will actually come about. First of all, I think we've been in this low inflation world for a good while. If you look at last 5 years, and I would actually say even further back, interest rates and inflation is coming down. I think if I look at over the next 5 years, that's something I see changing. So I would probably see inflation being a little higher than what we're dealing with. Inflation is generally a good thing for companies in nominal world because it kind of, it helps people grow. It takes care of fixed costs, but only for businesses that have pricing power. So I think pricing power is one of the key things that I would think that one of the winners over the next 5 years, one of the key winning points that would be needed for the next 5 years to come through that. Companies with pricing power, either they're industry leaders or there are brands or whichever sector they might be in investment. Irrespective of the sector, it's the characteristic of the business, which in my opinion will lead them to gain market share and ultimately make them more profitable for investors overall. The second thing I would say is that, overall, the essentials related demand, if I were to look at it that way, has played enough. I mean, if I look at, I don't want to get into stock specific, but you know what I'm talking about when I'm talking about essentials demand is basically roti, kapra, kind of, the basic things that we need in life. I think, to that space has been steady, slow and steady, and has been there or thereabouts. And there is I see a lot of mispricing with regards to sectors which cater to deferred demand and investment demand. So when I say deferred demand, where particularly in the COVID pandemic, we haven't spent at all, and we are probably when we go out, that's the first few areas I would look to spend. So those would be one area that I would kind of look to get into. Investment demand is other area, I think, as Manish mentioned, that overall since GFC and even kind of over the last 5 years, I would say that India hasn't seen an investment cycle. So I think there's a reasonable chance that we might see some of that. So those would be the two areas that I would focus on.
Right.
The area that I would be careful about would be basically areas that deal with the lost demand, which are basically either disrupted by digital adoption or the nature of the demand, like for instance, how we watch television, how we watch, how we go for entertainment, might actually see a bit of change once we go to the other side. So those would be the areas that I would be careful about when I look into the next 5 years.
Nice. That's really insightful. Thank you for also answering what areas probably to avoid. Prateek, ASK has always bet on the entrepreneurial capacity of Indian, in the Indian demographic. Okay. Will you continue to do that going into the next 5 years? And what areas do you think Indian entrepreneurs can probably disrupt, like Manish said or Tridi seconded? What do you think is going to happen in the next 5 years?
Yeah, so backing high quality, high in governance entrepreneurs is a great way to invest. They have skin in the game, fire in the belly. They want to make monies for themselves. They grow hard. Growth is what creates value, and given the governance as a high constant, people who associate with them will make or have a very high chance of making good amount of money. So that is a very enduring theme, and that is something that we will continue to do. If I say that, and to your question, the combination of quality and growth, what makes a business do very well over a period of time, is scarce. It is not littered on the street. If you see what you have held, if you see businesses who have done well for a substantial period of time, good or bad. So future can also be good and bad. To project 5 years hence, how the journey would be, yes, we hope it will be good, but we can have a demon kind of a period again. It has its ups and downs. Life has its ups and downs. So for companies who have gone through a period of 10 years, done spectacularly well, the first job is to focus on the same companies. 70-80% of people who will do your 20% expectation over the next period are going to be found from there. How is next 5 years going to be so different from the last 6-7 years? There will be a lot of similarities while there will be some differences.
That's very, very important.
So, if you even look at how the stock prices of various companies who have done very well over the past 10 years is seen, you break it down. Have they done well similarly over 7 years? Have they done well similarly over 4 years, 3 years, 2 years? And if you see the vigor in the price, if you see the vigor in the delivered numbers, in the management being there, chances are the same companies can do very well into the future. So that is the first point. Second, yes, there are new businesses happening. Internet is a huge thing. Earlier, everything was in the private domain, or most of the things were in private domain. Now they are getting listed. Some of those could do very well. In fact, some of the, while listings are happening at a particular valuation, they are making some of the earlier listed names look very cheap. And if one sees through that space, you could actually find free cash flow generating businesses available very cheap versus the newer names which are getting listed, and maybe there is an upside. It maybe helps to look at that space. Secondly, in the chemical pharmaceutical space, COVID has really helped the situation, and the associated, so hospitals, diagnostic chains, etc. COVID has been free publicity. People have been forced to go to diagnostic chains, for example, to get themselves examined. Globe has focused on Indian pharma for its ability to deliver huge quantities of medicine cheap. What millions, billions of dollars of advertisements of promos would not have done, COVID has done. And the next period, one should expect Indian companies to benefit out of it. On valuations, this space, the pharma space, does look similar to where it was several years back. Yes, there are issues on compliance, etc. Hopefully, if they get taken care of, we have good chances here. Similarly for chemicals, so in terms of sectoral, this thing, pharma comes under chemicals, but in terms of especially specialty chemicals, China plus one, the fact that other regions of the world don't want to manufacture too much of chemicals does mean that India has a unique opportunity. Many companies have done very well, so I'm not saying they are cheap anymore, but if looked over a period of 5 years and the kind of compounding you are saying, I think that's another space.
Right. Pratik, so we have a little bit of time left, but this is a very important question that I want to run by all of you, and maybe you can take a minute to probably answer on this. How do investors actually make this money? Because I ran a poll during Bharat Bhai's session and I asked how many of you actually held through a 100-bagger stock or a 10-bagger stock or whatever. Only 12% said they did. So, and being in the markets, and you guys have experienced that through multiple cycles, and I am kind of sure that it might repeat. A similar kind of story might also repeat for investors, where businesses have done 20%, it portfolios haven't. So in very, very concise way, just your advice to investors to, go through that, what should investors do? And with that, we will wind up today's discussion. So Pratik, we start with you.
So, people put it very simply, don't cut your flowers to water weeds. If there is something that you have got right, let it go on. What typically I have seen people do is buy at 100, the stock does 110, sell that, buy something which hasn't done as well. Chances of that stock which has done well is higher. Let it run its course rather than, cut it and put money somewhere else.
And that's your theme for the next 5 years as well.
Stick to high quality in every sphere.
Right. Tridi?
I would say that in next 5 years is going to be years of pricing power. So, stay with companies with pricing power and don't get swayed by the near-term quarterly earnings this way or that way. I think that will, if you've done so, that will hold investors good over a period of time and give the compounding.
Manish?
I think the best way is to keep things simple and don't complicate things when it comes to investments. The second factor is keep the noise out of the system. There's just too much of noise out here, too much of information, too much of data being thrown, less of information, too much of data being thrown. And one has to train one. And the third point is one has to really train oneself to not flip through a good business. The problem is that multi-baggers are only visible in hindsight. You understand businesses, and the businesses just keep on growing. That gives you a multi-bagger again and again, whether it be Page, Bajaj Finance, so on and so forth. So, this happens. There are plethora of ideas that come to a fund manager or an investor on a daily basis. The urge to not trade on a new idea, unless necessarily required, is the key to have a multi-bagger portfolio, provided your basic thesis of picking up stocks is correct.
Right. So I think on today's session, we have covered the most important things. What are the essential attributes? What is conviction? And then what are the sectors and what could be the businesses? Very, very insightful. Pricing power, capex, and Pratik, your point, hold on to the winners. Most likely they are going to be the next winners as well. These are very interesting points, and also a little bit on behavior of investors. So thank you to the esteemed panel, Tridi, Manish, and Pratik.